Welcome to Bloomberg ETF IQ. I'm Scarlet Fu.
And I'm Katie Greifeld. It's our last show of the year, and we are doing it big. We have BlackRock, JP Morgan, Vanguard, Grayscale. I'm almost out of breath.
You know, it feels like we're ending the year on a high.
Apparently, we'll see how it goes the next 30 minutes, because in a few minutes, we'll be speaking with Rick Rieder. He is Global Fixed Income CIO over at BlackRock. We'll be talking about his new ETF launch.
And we also have new active fixed income funds from Vanguard. Sara Devereux, the firm's global head of fixed income, swings by the show.
And my conversation with Grayscale CEO Michael Sonnenschein on the race for a spot Bitcoin ETF. And as always, before we get there, Eric Balchunas from Bloomberg Intelligence. He's here with us now, taking a look at the flows. Eric, what do you got?
Katie, Scarlet. Okay, last show of the year, I should go over the yearly flows. Okay, we normally do every week, but let's look at the whole year. I call this the horse race, right? So look at year to date. You've got number one, VU, 42 billion. SPY out of nowhere is up to 39 billion, the second spot, and IVV third. I call those the three amigos. Those are the three S&P 500 trackers from the three big issuers. And it's interesting, those three ETFs took in about 30% of all the flows this year. That is their record take, because if you just bought the market, you beat almost every other trading strategy. These are up 25% this year. That's about 3 times what you're supposed to get with the S&P 500. So huge year in the market. TLT number 4, that was a big year. People really tried to fight the Fed early in the year, buying TLT, thinking the Fed would cut rates earlier than they did. They didn't. Now it's working now, but $6 billion was lost in the process. And then you've got Total Market and some of the usual players. JEPI, also notable. That's the big active ETF that's breaking all the records. JP Morgan with a huge hit there. And Quality. Quality has been the factor of the year, so that not surprising to see that at 10. Let's look at the outflows. The top of the list, speaking of Quality, is the fund that BlackRock sold to buy Qual, which is ESGU. ESGU, kind of tough year, sort of reality setting in, hasn't performed as well. That's at the top there. EEM, not great for there either. Again, anything out of the U.S. has struggled versus the U.S. And then you got USMV, that's minimum vol in there. So again, but not a lot of outflows relative to the inflows. So let's look at the $535 billion this year compared to the past 10 years. And you can see it's the third best year ever. Just shy of last year, but Decembers are strong. We could actually pass this last year and have the second best year ever. Doubt we'll meet 2021. That was a crazy year, almost $1 trillion. But look at the equity to fixed income ratio, about 2 to 1 this year. Same as last year. Almost the same as the year before, equities a little higher. 2020 was the outlier. That was a crazy year with COVID. Commodities did way better than normal, fixed income. But we're kind of back to this normal situation here with fixed income being popular, but not nearly as popular as equity. So, but either way, again, a lot of this is money moving over to the ETF format as it's the more preferred vehicle.
All right, we're back to normal. You heard it here first. We'll see if we're still normal in 2024. But let's move on, because joining our conversation now is Rick Rieder. He is CIO of Global Fixed Income over at BlackRock. Rick, I'm thrilled to have you with us, and this is an ETF show, but I have to ask you about the Fed, because it has been a wild last week. Of course, we got a surprisingly dovish Jerome Powell last Wednesday at the press conference, and then the days that followed, we've heard from John Williams, Raphael Bostic, Austin Goolsbee, et cetera, seemingly pushing back against how the market interpreted Jerome Powell. What do you make of all of it?
It was wild. I mean, the last couple of weeks have been pretty incredible. So the Powell, I mean, I thought what was interesting, most interesting about Powell is there was no pushback on financial conditions easing, and which was pretty stark contrast to where they were a couple of weeks ago, 3 weeks ago, or no reference to we still are fighting inflation aggressively. I mean, I was pretty surprised by it, but then, markets took it dovishly, and including pricing in that the Fed would start cutting in March, which I still think is early. And then, but then you said, I thought the one that was significant is John Williams coming out. That was unscheduled, and coming out and saying that the markets are being a bit presumptuous. So anyway, I think the market reaction pulling back a bit today, reflective of, I don't think Chair Powell meant to be that aggressive about starting to cut this quickly. And so I think today's retrenchment makes some sense to me.
And you are seeing the markets recalibrate a bit to that. Let's wrap this into the reason we do have you, which of course is you launching your second ETF. Of course, you've managed fixed income for quite a long time, but you're relatively new to the ETF wrapper. And last week, you launched the BlackRock Total Return ETF. Of course, you manage total return strategies in mutual funds. And when I think of total return, I really think of a go anywhere type of strategy. And against that backdrop that you just described with the Fed, if you can go anywhere in the fixed income market right now, where's the most opportunity?
So, I mean, the one thing about total return, I mean, we're doing it, quite frankly, because we think the demand in this wrapper and this type of wrapper for many that are using models, and quite frankly, after a year like this, where people are looking at a balanced equities, total return makes a lot of sense. So the total return tends to be, we still model it to the aggregate index, but we're trying to outperform the index. So what do you do today? Listen, some of the credit sectors still make sense today. Both the investment grade market we think makes sense, a bit of high yield we think makes sense today, and agency mortgages that where we think there's some real value today, to take advantage of. Where we don't think there's a lot of value is what we just talked about, the front end of the yield curve getting ahead of the Fed, presumably. That we've started to pull back on, and we're underweight there. But gosh, we still think the spread sectors, you can create a bit more income than the index, and that's where we think there's the best value today.
Rick, we recently caught up with JP Morgan Asset Management's Brian Leak, who of course is the global head of ETF Solutions there, and he discussed the room that's available to grow in active fixed income ETFs. Take a listen.
And you could see the ETF industry double from kind of 7 to 14, 15 trillion dollars. And I think active could be 10 to 20% of that. So there's your 1.5 to 3 trillion dollars in active ETFs. Big starter there is on the fixed income side.
Yeah.
And you know, the thing that I hear from investors is they're just underwhelmed with how fixed income indexes are constructed. A fixed income index is going to weight the heaviest debtor as the biggest component. And that's not how I or you probably think about your fixed income exposure in your portfolios. And so when you can use active management to correct for some of those things, provide that outperformance.
Rick, I want to get your thoughts on how big you think this market can get now that the Fed pivot is happening.
Well, so by the way, I agree with everything that was just said. So let's say a couple of things. Firstly, you know, active management fixed income generally outperforms. I've seen numbers from Morningstar that show that something like 85% of managers outperform in fixed income. The reason why is you get, in fixed income, there's 68,000 securities. It's pretty extraordinary versus the S&P 500. There are so many unique things you could take advantage of in the fixed income market. Your ability to build income and then manage your beta in fixed income is one of the key tools and objectives you can create, and which I think makes a lot of sense over time. So I think active fixed income is going to grow quite a bit. I mean, the growth of the mutual fund industry in fixed income has been huge. And you know, we launched, as you said, our BINC ETF back in May, and we're pretty impressed with how fast it's growing. And it's, you know, that's a fund or an ETF where you can put a lot of income into it. We were running 7% with a drop in rates. We're still running mid to high sixes, which is super attractive. And you know, one thing about fixed income, it's really hard for the average investor to find unique commercial mortgage securities, unique CLO securities. It tends to be a more opaque market. And so the ability to do that, create a lot of yield without a lot of volatility, is something that people crave from the both retail, model-driven, and institutional.
And Rick, earlier you mentioned the short end of the curve and low duration. I want to get your take on TLT. This fascinated us all year. We had $20 billion poured into it, and it kept going down and down. I think it lost 18%. People kept going in and in. It finally worked about in the past month. What do you do now? Just curious if you like the long end of the curve and TLT in particular, and what you made of this year and all the flows that went into it.
You've highlighted what I think it's truly been the most curious thing. The demand, and like you say, I mean, the money was coming in, the markets were going down, and the money kept coming in. It was really curious. Listen, I don't think the long end of the yield curve today is very attractive. If you talk about a 4% long bond, when you can get more than that in the front, and you don't have to take the duration risk of being in the back end of the curve. The thing that's pretty incredible, if you go back in history and think about a 4% long bond, that's not that attractive. You think about what normal term premium is. You think, you know, relative to history, that's not that attractive at all. It's where it's really attractive. I said I didn't like the very front end. I don't like the very long end. It means I like the middle, and I really like the belly of the yield curve, where you get, that's the fulcrum point for when the Fed starts easing. That's where the forwards are really attractive, and that's where you can create a lot of return, and certainly on a risk-adjusted basis. Like you say, the demand that's come in on the back end of the yield curve has been one of the most curious things that I've seen. Now, one thing that it certainly is happening, pension funds that have done well in their equities can now lock in these yields. So there's some of that that's going on, but the sheer size of that demand has been truly eye-popping.
Okay, guys, write that down. It's the belly is where you want to be when we finally get to that pivot point. But Rick, I want to talk a little bit more about you because, okay, you launched Bank back in May, I believe it was. That was very exciting for the ETF industry. Now you're out with your total return ETF. Again, like I mentioned, a strategy that you're very familiar with, have been managing in a mutual fund wrapper. Would you ever consider converting some of your mutual fund strategies just into ETFs?
So listen, I mean, they're different products and different wrappers. I mean, one thing in a mutual fund is I do a lot of things. We're able to do a lot of things around sort of bespoke financing. I do a lot of hedging in the mutual funds that allows me to keep our volatility relative to our risk, relative to our return at a reasonable level. So I think, listen, I think the mutual fund industry is going to survive and live on for years. And, you know, you can run a really, really effective strategy in mutual funds. You know, we run a fund called SIO, which is our Strategic Income Fund, that allows us to create, I mean, we've created almost double the return of the ag at half the volatility for years and years. And it's because I can use so many tools to do it. But listen, I think people really like the facility of using ETFs, put them into models, use them for tax strategies. So my sense is the growth will clearly happen in ETF form, but I don't think the mutual fund industry is going away anytime soon. And quite frankly, I find it super effective to manage portfolios with today.
You know, as we're having this conversation, I'm thinking about how in the ETF world, there are definitely natives and then there are tourists, meaning there are ETF people and then there are people with ETFs. So here on this show, Eric and Katie are the natives. I'm the tourist. But increasingly, the people with ETFs are now heavyweights in the bond world, right?
Of course, we have Rick Rieder, who we're in conversation with right now. But we also saw PIMCO's Dan Ivison, for example, also come out to the ETF wrapper this year.
So, Rick, what do you notice, what do you observe as a tourist that the natives don't necessarily appreciate?
So I'd say a couple things. First of all, I've been, my funds, I've used ETFs for I don't know how many years. I mean, they're incredibly effective to get in and out of. And I use the high yield market to at least use HYG constantly, LQD, constantly manage my beta. You know, when I'm waiting for new issues to come and I'm trying to get some exposure, I'll use HYG when I'm trying to ramp up or ramp down. So anyway, ETFs are super effective, and we'll continue to utilize them. Listen, I think the thing that is being, having managed so many portfolios in different forms, in many forms over the years, you get a sense for how do you run the style a little bit differently. In the ETF, for total return, for BlackRock total return ETF, for Bank, I'm using more products that are more transparent so that people can replicate them, that like to put them into models. But to keep, one of the things we're doing, keep the yield up, keep the diversification up in the ETF, and do it similar to what you would do in a mutual fund. But people desire all types of forms to invest, and this one I think is going to continue to grow. And like I say, the amount that I trade, not just in fixed income, in a lot of the equity ETFs, I mean, they're incredibly effective in a portfolio to manage your portfolio allocations.
All right, so it's not either or when it comes to mutual funds versus ETFs. We can all coexist together happily. Rick, that's a really nice place to end it. Really enjoyed speaking with you. Thanks for your time. That is Rick Rieder, of course, of BlackRock. Now coming up, my conversation with Grayscale CEO Michael Sonnenschein about the approval timeline for spot Bitcoin ETFs. That's next. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. Time now for the ETF Brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with authorized participants, of course, a very important part of the ETF structure that we don't talk about a lot. And some really interesting data out that shows that increasingly it's just 3 APs that really handle the bulk of flows. We're talking about Bank of America, Goldman Sachs, and JP Morgan growing more concentrated there. So definitely something to watch. Let's talk about the ETF league table. Since this is our last show of the year, of course, it's BlackRock and it's Vanguard. BlackRock has been in control since 2006, but as you can see there, that orange line, that's Vanguard's market share. So increasingly getting closer and closer to BlackRock. We'll see if the flip happens in the next year or so. But I do want to end on the Grayscale Bitcoin Trust. It's not an ETF. It would would like to be an ETF, you're taking a look at its discount right now. Of course, we are counting down to the potential final decision from the SEC, whether or not they will allow spot Bitcoin ETFs to launch. I talked about that with Grayscale CEO Michael Sonnenschein.
Well, I think the SEC now has, certainly on the heels of our court decision earlier this summer, where the DC Circuit actually ruled that the SEC was acting arbitrarily and capriciously, I think that the SEC should and does in fact want to create an even playing field. And so we've publicly been advocates of the fact that when the commission is ready to give the requisite approvals for spot products to come to market, that it should be done all at once.
And it was interesting, Scarlet, to hear him advocate for the SEC approving everyone at once. We've heard other people argue for that, but it's still unclear whether or not Grayscale falls into that timeline or whether because they're asking to convert, whether they have the same deadline necessarily.
Right, they're not actually a new filing in the same way that the other spot Bitcoin ETFs are. And of course, we spoke with Ugo Egbenike of Jane Street earlier last week, and he also made the point that the market seems to be preparing for this idea that there is no first mover advantage among all the different companies looking to launch ETFs in the Bitcoin space.
Yeah, it has definitely been a long trip to even get to this point, I would say.
Yeah, absolutely. All right, well, still ahead. So we've heard from BlackRock, we've heard from JP Morgan. Next up, we're going to hear from Vanguard. Sara Devereux, the firm's global head of fixed income, joins us to drop some ETF IQ. This is Bloomberg. This is Bloomberg ETF IQ. I'm Scarlet Fu along with Katie Greifeld.
It's time for today's drill down where we focus on one ETF. Eric, hit it.
Katie, thank you. The last one of the year, it is a Vanguard Core Bond ETF. VCRB is the ticker. It just came out. It's hot off the press. And Vanguard is known for passive, but they are the third biggest active manager. And get this, they're the biggest active bond manager in terms of U.S. funds, even bigger than PIMCO. So it's not a surprise if you're in the industry, you know Vanguard is very big in this space. Actively managed. Look at the fee, 10 basis points. That is by far the lowest for something that is, again, using active managers to try to beat the ag, right? So, but this one's not going too crazy. It's just trying to beat the ag a little. Let's look at the mutual fund that this ETF is sort of cloned after. And you can see it's VCOBX. The ETF doesn't have any history, but the mutual fund does. So here's a 5-year history here. It's up 9% versus the ag at 5%. That's pretty good. I mean, 3.89% outperformance over that in the bond world, that's a lot. So that is why the mutual fund has grown big. And Katie, look, if you combine the Vanguard name, this kind of outperformance, and that 10 basis point fee, look out.
Eric, thank you. And joining us now to talk about this ETF, I'm thrilled to say we have Sara Devereux. She is global head of fixed income over at Vanguard. Sara, it's great to have you with us. I was excited about this one because Vanguard doesn't launch too many products. Very slim, relatively speaking, ETF lineup. Why bring this ETF strategy forward in this wrapper at this moment?
Well, thank you for having me here today. As you talk about a lot on the show, ETFs have proven to be the vehicle of choice for many investors. And that's no surprise with tax efficiency, low cost, and they're liquid. So we launched BND in 2007, and since then we've seen a lot of clients prefer this vehicle. So really, this is just another phase in our ETF journey, moving into the active phase with the launch of Core and Core Plus bond ETFs.
So we know that a falling rate environment tends to make fixed income more attractive. To what extent does the end or the long anticipated end of this hiking cycle prove to be a catalyst for fixed income, active fixed income ETFs?
So we really think that we're in a new era for fixed income, one that's going to generate higher returns over the long run. Currently, returns are very attractive compared to where they've been in recent history. We're no longer at the zero lower bound. So when we're looking forward, we think there's going to be a lot more opportunity in fixed income in general. So the most important decision is making the allocation decision to get bonds in your portfolio. Index is a great starting point, but we think also active is good for some people who have a higher risk tolerance and they're seeking to beat the benchmark. Currently, we do believe there's a lot of opportunity in active, really for two reasons. First of all, volatility has been running high. And when there's volatility, that creates dispersion. Dispersion can be monetized by active managers. And the second reason is really that we're going into this uneven economic environment. And that's an environment where you really want to be leading into security selection and using research teams to do deep dives on each individual company and making sure that you're picking the very best companies to go into the portfolio.
And Sara, I've written about Vanguard's fixed income ETFs. I equate you guys to bringing a gun to a knife fight in that your fee is so low, you don't really have to take that many chances, because other issuers, if the fee's that high, they've got to kind of go out further, because in fixed income, there's not a lot of return, so they got to take some more risk. Can you talk a little bit about the general philosophy and how aggressive versus conservative you are in running this fund?
Absolutely. So yes, we have a material expense ratio advantage, and obviously that means you take home more of the return, so that's terrific. But maybe even more importantly, the fee can influence risk-taking behavior. So we have low fees. That does not necessarily mean low risk. We think it means smarter risk, and that's an asymmetric benefit. For example, when risk return is really, really attractive, we can deploy just as much risk as our peers, and we do. But when risk reward is not attractive, we really just have that optionality, right? That to be opportunistic, and we can remain patient when our high fee competitors can't afford to do so.
And Sara, we don't have much time left, just about 40 seconds left with you, but talk to us a little bit about what type of risk is the risk to take right now. Is it duration risk or is it credit risk? How are you thinking about that?
So in this part of the cycle, we've been wanting to pair high quality spread product with a long duration. That's a trade we've had on for some time, and it has performed very well. In fact, it performed more quickly than we expected it to. So we've recently pulled back in our positioning and risk-taking in that sense. That being said, looking forward, we do have dry powder, and we're going to be nimble going into the new year. So we're going to be looking to deploy that into parts of IG and the higher quality parts. We like financials, for example. We think they've lagged performance year to date, and the banks are really cleaning up their balance sheets, and the rally in rates has made their securities portfolios more stable. And we also like the short end of the investment grade curve, because that's just an area that's lacked sponsorship, so the valuations are more attractive. Finally, I would just make one quick note in the rate space. We've been really active in the global rates market. For example, we like emerging market rates. We've been long Mexico because we think there's more room to cut versus the U.S.
All right,
and we've
Sara,
been short
unfortunately,
JGBs
gotta
in
leave it
anticipation
there.
of the Bank
That
of
is
Japan.
Sara Devereux of Vanguard. And just a quick reminder, we'll be back after the holidays on Wednesday, January 3rd. Happy holidays. This is Bloomberg.